Looking at where gold and silver market structures have settled following literally billions of unbacked February gold and silver options and the OCC bets. You remember we talked about the OCC bets, which are the Office of the Comptroller bets. They're listed, they're a quarterly report, and it shows 5 banks with short gold and silver positions or gold and derivative gold and silver positions. And they all had to be marked. Everything had to be marked to a market price, i.e. you pay up or you lose or you win. And that happened ahead of last Thursday's, what we call first notice day, which is where any gold futures positions, OCC bets like that, any that could not be paper settled had to be fully funded and then stood for physical delivery. That is particularly the case in the COMEX. And it became clear that COMEX open interest, i.e. the number of 4% gold-backed gold chips, and they're not gold, of course, they're casino chips, but they're backed by kind of 4% gold. And these casino chips are lent out into the market by the casino. But what we've been noticing is that this open interest, well, these chips have been actually contracting, reducing into a rise in the gold price. What that telegraphed was that the official sellers, pit managers, i.e., were capitulating bearish bets against gold into what is a physically driven rally that's got away from them. In fact, even the deliberately stale dated, we only get the odd report, nothing from the LBMA, but the COMEX is required to do a weekly report, and it's so stale dated, it's ludicrous. It could be published every day, at the end of every day, much like TOCOM used to do years ago and suddenly stopped for some reason. Why? Because we drew attention to it. But these reports that get published could be, as I say, could be published, could be reported at the end of every day. They're delayed by 3 solid days. So when they come out, it's almost pointless, other than it does provide some footprint. But these reports, these COT reports, as we call them, what they're actually evidencing, and it's impossible to hide, is that into a rising gold price, gold futures contracts are not anywhere close to being historically overbought and continue to look bound for $3,000, which will then become the next higher stair step to $35.
As we've been consistently tracking, this is a very, very similar setup to what we witnessed after the Shanghai Futures Exchange launched last March.
Let's get one thing straight right off the bat. What's happening in these gold and silver markets isn't accidental, and it sure as hell isn't organic. You're looking at a system that's been engineered for decades to suppress price discovery in order to protect a broken fiat system that's increasingly on life support. And now, that game is coming undone in real time. Now let's break this down for our viewers who may be hearing about this for the first time. When we talk about the COMEX, we're talking about a casino. A derivatives casino where gold and silver are not bought or sold, they're bet on. You've got billions of dollars of unbacked gold and silver contracts, futures, options, and more that never ever result in the actual physical delivery of metal. These are just chips, paper chips. And the astonishing part is this: the gold and silver backing these paper contracts is maybe 4% of what's actually traded. Think about that. It's the same as selling 25 movie tickets for every 1 seat in the cinema and hoping most people just don't show up. But what happens when people do show up and demand a seat? That's what's happening now. We're seeing this open interest, these outstanding contracts on COMEX contracting into a rising gold price. That's not how a normal market behaves. What that tells us is that official sellers, the bullion banks, the pit managers, are backing off. They're covering shorts. They're capitulating, because this isn't just a speculative run-up. This is a physical market-driven rally. And for the first time in a long time, the physical market is biting back. Now, what's the catalyst? Look no further than Basel III. Basel III regulations, which reclassify gold as a Tier 1 asset equal to cash, have fundamentally changed the rules of engagement. The fractional reserve gold system the LBMA and COMEX relied on, That's dead under Basel III. Banks now need to own the metal if they want it on their balance sheets. That's a game changer. It's no longer profitable or even possible for these bullion banks to keep naked shorting gold and silver without severe regulatory cost. We've also got First Notice Day. That's when all these options, these OCC bets, the Office of the Comptroller of the Currency shows 5 major banks with massive gold and silver derivative exposure. Those contracts come due. If they can't be settled in cash, they need to be backed physically. And the way the COMEX is structured, when more people start standing for delivery, and I mean actual truck the metal out of the warehouse delivery, the wheels start coming off. And let's not forget the deliberate opacity of this market. We get partial data, delayed COT reports, often 3 days late, which could easily be published daily. The LBMA, forget it. Try finding real-time data there. These are institutions that thrive in the shadows. And why wouldn't they? The last thing they want is a fully transparent, physically settled marketplace that exposes how mispriced these metals really are. Let me give you some numbers here. COMEX gold futures are nowhere near historically overbought levels. Open interest is well below the 600,000 threshold that typically signals a top. This is a strong setup. Gold's push to $3,000 isn't just probable, it's probable and then some. And $3,500? That's the next stair step. We're stair-stepping higher because the physical demand can no longer be ignored. It's not a short squeeze from hedge funds, it's central banks, sovereigns, and even institutional players who've never bought gold before, suddenly waking up. They're seeing the writing on the wall. In fact, if you compare this setup to what we saw when the Shanghai Gold Exchange opened its futures contracts last March, it's déjà vu all over again. Back then, technical traders kept calling for a top, blind to the fact that Chinese physical buying was leading the price action. Not COMEX, not New York, China. Physical metal, not paper bets. We saw a significant rally follow, and guess what? This time it's even bigger. And while these analysts are still using old models, anchored to the dollar, to bond market correlations that no longer hold, they're mispricing gold completely. Gold is breaking every model because we've shifted to a different regime. The price is no longer tied to dollar strength, or treasury yields, or Fed credibility. That game is over. Basel III rewrote the rule book, and now we've got one bank, just one, still trying to manage the dollar price of gold, the Federal Reserve. But they're alone now. The Bank of England? Not even a player. The ECB done. The Swiss? Long gone. Silver always lags until it doesn't, and when it runs, it runs. As we've seen in recent cycles, once gold punches through resistance, say $3,000, silver won't just tag along, it will outrun gold with double or triple the torque. That's where we are right now. Silver is still criminally undervalued, underheld, and misunderstood, but not for long. This isn't just a gold and silver story. This is a monetary story. This is about trust and the fiat system, saddled with $300 trillion in global debt, fractured by geopolitical distrust, and facing a confidence crisis, is running out of runway. Central banks know it. Sovereign wealth funds know it. The bullion banks know it. The only question is, do you know it? If you're still waiting for the green light to diversify out of fiat and into real assets, consider this your signal. It's not a warning anymore. It's a call to action. Stack smart, stay informed, and watch this space. Because what's coming next, it's going to rewrite the entire monetary chapter.
Where futures market top callers had failed to discern that it was Chinese physical market dragon that was wagging the COMEX paper market tail, and we saw a significant rally ensue. Now this is where it gets interesting, as many technical traders who keep calling gold market tops have not realized that historical dollar and bond market correlations are broken. And this means that all trend lines that were anchored before the Bank of International Settlements revalued gold as a first-year asset class 2 years ago are consistently mispricing gold futures extrapolations, and these so-called false overbought signals are actually stair-step by stair-step being overcome.
Now, obviously, this strong move into gold has largely been driven by global-facing central bank, sovereign, and institutional physical demand, forcing the market makers with a footprint in both the physical and the paper markets, as well as obviously the cash-settled COMEX paper markets, to race to buy back asymmetrically imbalanced bets, i.e. bets that are not one-to-one backed, they are skewed to the short side. So they're imbalanced. So they're forced to when we see these things happen and the physical market starts to take control, they're forced to cover these imbalanced bets against paper market gold. Now this represents an unprecedented change in behavior which rails against the only remaining central bank trying to manage the dollar price of gold, but with the Fed, of course. But with Basel III compliance closing in on US markets on the 1st of July, they're beginning to fold their hand early. Also, with gold outperforming every other asset class, a rising gold price has not gone unnoticed by fund managers who've never looked at gold investments before, and this massive move into gold has only just begun. This opens up an enormous amount of buying that was never there before.
Let's start right where we left off, with silver. See, the thing with silver is that it's been the most manipulated commodity on the planet, bar none. And that's not a theory. It's documented, provable, and playing out in real time. We're not talking about some wild conspiracy scribbled on a napkin in a pub. We're talking about actual mechanics that are visible to anyone who knows where to look. Let's zoom in on what's happening right now on the COMEX. Silver has been trading at what looks like a lull on the surface. You get your rinse cycles, your short-term washouts, and the price pulls back to the 31 level. But that's a paper illusion. The minute those speculators were shaken out, those casino players who jumped in long with borrowed money and no physical interest, the real buyers stepped in. And who are those buyers? It's not retail. It's not Reddit traders. It's sovereigns. It's Chinese buyers, Saudi money, Indian refiners, Russian buyers, and non-bullion bank commercial traders who understand one thing very well. This paper game is ending. Let me break this down clearly. At spot silver around $31, availability for immediate local London delivery simply doesn't exist. You can't just walk in and get size at that price. Yes, you can still buy silver, but you're going to have to pay a lot more than COMEX says the price is. That tells us one thing. COMEX and LBMA prices are a distortion. They do not reflect the physical supply-demand reality. And refiners? They've pivoted. The economics of refining right now favor gold, not silver. So when you place a bulk order for kilo bar silver, they tell you, we'll get to it later. We're doing gold first. That's not a small issue. That's a systemic red flag. What's the result? It's forcing major buyers to target COMEX 1,000-ounce bars, taking maximum allowable deliveries under the rulebook, 3,000 lots or 465 metric tons at a time. And they're not rolling the position. They're not moving it from registered to eligible. No, they're loading the trucks. This isn't smoke and mirrors. This is metal out the back door, headed east. Let me put it into perspective. This is the largest physical silver delivery event since the Hunt brothers in 1980. And unlike back then, the silver isn't staying in the COMEX warehouse. It's being exported to Shanghai, Mumbai, Dubai, and Istanbul, real markets where the price reflects real supply. The game is different now. They can't just halt trading and say, sorry, you can't buy anymore. That trick's been played, and everyone saw it. And while all this is happening, the COMEX silver open interest has remained extremely lean. In fact, it's almost laughable that traders still look at RSI and MACD and call silver overbought. What we're witnessing is a structural dislocation between a manipulated futures market and an exploding physical demand base. It's a coiled beach ball, and once it springs loose, it's going vertical. Now let's talk about something most analysts miss entirely. Exchange for physical, EFP spreads. These are arbitrage trades between COMEX and local London pricing. And what we've been watching, particularly over the last month, is a massive spike in EFP differentials. In plain English, it means the difference in price between paper silver and physical silver is so wide, It now covers the cost of air shipping 1,000-ounce bars from London to New York. You heard that right. Air freight premiums are being arbitraged by buyers who can no longer secure size in London, and so are backdooring into the COMEX system by forcing physical delivery there instead. And that tightening, it feeds back into both markets. It's a feedback loop. Less availability on COMEX, less float in London, higher prices everywhere, except on the screen, where the LBMA and CME cartel are still posting synthetic prices that are being laughed at by the global market. And it gets better. LBMA vaults are bleeding silver. January saw a record 70 million ounces flow out of LBMA vaults, 20% of the float in just 1 month. That's not a trickle, that's a strategic withdrawal. And February saw another 8 million ounces drain. India alone has imported over 800 million ounces of silver over the last 5 years. That's more than what's available in COMEX plus LBMA combined. Let me make that crystal clear. One country's imports have exceeded the entire global paper exchange float. Does that sound sustainable to you? Now, this is the existential threat we've been warning about. For decades, the West has controlled the gold and silver price via the COMEX and LBMA systems, using paper leverage, opaque reporting, and coordinated interventions. But now a decentralized physical-only market is emerging, and it's gaining critical mass. China's physical exchanges, India's domestic refining, Russia's bilateral gold settlements, the UAE's growing gold market, and soon we expect Africa and Central Asia to develop their own settlement platforms. And when those platforms require full allocation, immediate settlement, and no leverage, what happens to COMEX? It becomes irrelevant. In this new system, you don't get to settle your gold contract in dollars. You don't roll it. You don't offset it. You either have the metal or you don't. Full stop. And now we're hearing serious chatter about revaluing gold, as Andy Schectman has said. The U.S. Treasury's gold is marked at $42.22 an ounce. That's absurd. Revaluing it to just $10,000 gives the Treasury over $1 trillion in balance sheet equity. That's not a conspiracy theory. That's math. That's policy preparation. And what of silver? If gold goes to $10,000 and silver simply returns to a historically normal gold-silver ratio of 50-1, you're looking at $200 silver. If it overshoots to the 2011 ratio of 33-1, $300 to $350 is possible. And let me remind you, in 1979 to 80, silver hit $50 while gold was at $850. Do the math. Now let's take it a step further. This movement is being reinforced by the biggest players in the world. Zoltan Pozsar, formerly of the New York Fed and Credit Suisse, now openly talks about Bretton Woods III, a new monetary system based on commodities-backed money. That's gold. That's silver. And it's not managed by the West. It's driven by Asia, the BRICS plus bloc, and non-aligned central banks that want transparency, trust, and sovereignty in their reserves. What are they calling for? Blockchain-settled treasuries pegged to gold, with stable coins as digital wrappers for cross-border trade. Judy Shelton has echoed this. Elon Musk has echoed this. Even Trump, in his own populist way, is hinting at tariffs, gold-backed instruments, and sound money reform. We're on the brink of monetary transformation, folks, and at the center of it, gold and silver. Not just as relics of the past, but as the foundation of the future. A system built on real money, real trust, and real value, not printed digits, rehypothecated paper, and artificially suppressed prices. So where does that leave you, the individual investor? Simple. You either prepare for this transition or you get caught holding the bag. This is not a dress rehearsal. The float is drying up. The vaults are emptying. The leverage is breaking. If you still think there's time, look again. If you still believe the price on your screen reflects reality, think again. And if you're still on the sidelines, it's time to act. Stack smart, stack physical, and stay ahead of the curve. Because that curve is about to become a vertical wall.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. join our free gold and silver newsletter today, link in the description.